So we covered direct material, direct labor, and now it's time to do factory overhead. So for factory overhead, the company would have an estimate of each manufacturing overhead cost expected, and then they would put it into a budget so it would look like this. Okay, now we're going to look at the cost of goods sold budget. So we know that the cost of goods sold statement, we know what it looks like. This is going to look the same, but instead of actual numbers, it's going to have budgeted numbers. So we will have the direct materials purchases budget, the direct labor cost budget, and the factory overhead cost budget. And those are the items that go into the cost of goods sold budget. And then we need to know estimated and desired inventory for all of those items. And then they will be integrated into the cost of goods sold budget. So let's see what that looks like. So we have direct material here. We have work in process, or our beginning inventory, and finished goods. So there is our beginning inventory, and we also have the same information for our desired ending inventory. Okay, so let's just look at this cost of goods sold budget. It looks just like what we've been doing, but it's budgeted numbers. So let's look at the cost of goods manufactured section first. So the cost of goods manufactured section, it starts on line 5 and it goes to line 20. So this is what you expect to see cost of goods manufactured. You start with the beginning work in process plus your direct materials used, your direct labor, and your factory overhead, minus your ending work in process. That will get you to your cost of goods manufactured. And then we drop that into the cost of goods sold statement. Cost of goods sold has to do with the finished goods we sold. So we're going to take beginning finished goods up here, plus your cost of goods manufactured, that's what we added, minus your ending finished goods, and that gets you to your cost of goods sold. Now we're going to look at the example exercise, and it's giving us the same information that we've used before. So we have 47,000 brass plaques that we need to make, and we need brass sheets to make them. So it takes 96 square inches of brass sheets for each brass plaque. The beginning inventory is 240,000 and the desired ending inventory is 200,000, and the sheets cost 12 cents per square inch. So we have seen this information before. Okay, so remember we budgeted $47,000 in 2025. It takes 12 minutes to engrave each plaque, and the engraving labor costs $11 per hour. Our estimated inventory for finished goods, this is new information provided here. Beginning finished goods is 54,000 and beginning work in process is 47,000. So we have the desired ending inventory and factory overhead. So these are the numbers we're going to drop into the cost of goods sold budget. So again, let's focus on our cost of goods manufactured first. That starts with work in process down to cost of goods manufactured. So you have direct materials, which you can get straight from your direct materials budget already. Direct labor, straight from it. Factory overhead, straight from it. So beginning WIP plus your total manufacturing costs, less your ending work in process, gets you to your cost of goods manufactured. After we have our cost of goods manufactured, we can calculate our cost of goods sold. Start with beginning finished goods inventory. This is given to us. Plus your cost of goods manufactured will give you your finished goods available for sale. Subtract out your finished goods inventory, ending inventory, and that will get you to your cost of goods sold. And keep in mind that ending finished goods they just gave us. So here you can see that they give you the desired ending inventories and the beginning inventories for finished goods and work in process. So that information was given to us. Next is our selling and administrative expenses budget. And we're going to have our estimated budget for our selling expenses. And you also have your administrative expenses to get your total selling and administrative expenses. So this budget looks just like our selling and administrative costs. The only difference is these numbers aren't actual numbers, these are budgeted numbers. Then we'll use this and other provided information to make a budgeted income statement. And this looks like what we've always done. And you're using these numbers that we got or we calculated from those previous budgets. Alright, now we're going to look at the financial budgets. We have the cash budget and the capital expenditures budget. And the cash budget estimates the expected inflows and outflows of cash for a period of time. And let's just take a look at the cash. So this is going to tell us how much we think our cash inflows are. Some of our money will come from current sales and some of our money will come from previous sales just now collected. So it will tell you what percentage you expect to collect from the current month's sales and what percentage you expect to collect from prior month's sales. And then you add those together to figure out how much you will receive each month from those sales. In January, some of this comes from current month sales and some of this comes from prior month sales. But the total amount we think we will collect from January would be $1,128,000. Cash payments are how much we think we're going to pay out. So we have an estimate of what we think we'll be paying out, and we will drop it into a budget. And this is what it would look like. Payment of prior month's manufacturing costs, and it tells you what percentage to use. We think will be this, and current month's manufacturing costs we think will be this. Now, why it's not just using current months, because sometimes we buy things on account, and that means we don't mean to pay this in the current month. So this takes into account what we think we're going to be paying this month and what we're going to be paying the next month. Okay, so the cash budget is structured as follows. Estimated cash receipts minus estimated cash payments will tell you how much cash increase or decrease you have, plus the cash balance at the beginning of the month will give you the cash balance at the end of the month. And then you have what you want to end with, a minimum cash balance, because we never want to have below zero. And that will give you your excess or deficiency. If you have a deficiency, you would want to get a loan to cover that deficiency. Alright, so the following is given to us for the cash budget. You have the cash balance here, quarterly taxes paid, quarterly interest expense, quarterly interest revenue, selling equipment purchased, and then your selling and administrative expenses paid in the month. So we're going to take this information and drop it into the budget. So estimated cash receipts. So that came from our schedule of collection from sales, which is right here. So you can see the number, where it came from. And then we have our interest revenue, which they gave to us. And then our estimated cash payments for manufacturing costs, which came from the schedule of cash payments for manufacturing costs. which is this right here, 802. Then the selling and administrative expenses, the capital additions of the sewing equipment that was provided to us in the information, and your interest expense, your income taxes. So you have your total cash payments, your increase or decrease in cash, your cash balance at the beginning of the month is added to give you your cash balance at the end of the month. And then your minimum cash balance will give you your excess, which we had in January and March. In February, we had a deficiency. All right, here's an example exercise. Land and Awards Company collects 25% of its sales on account in the month of the sale and 75% in the month of the following sale. If the sale on account are budgeted to be $100,000 for March and $126,000 for April, what are the budgeted cash receipts from sales on accounts for April? So for March, it tells us that it expects to get 75% in the month following the sale. So our collections from the March sales in April would be 75% of our March sales, so we will collect $75,000 in April. Then in April, we think we're going to get current month's 25% of its sales. So 25% of April sales would be $31,500. So the total receipts from sales on accounts would be $106,500. So the last one we have to talk about is capital expenditures. How much we plan to spend for acquiring new fixed assets. So they have to tell us what our plans are, and then we drop it into a budget. So these plans usually planning for multiple years further in advance because these are big expenditures. For machinery in the cutting department, we plan to buy new in these years. And machinery for the sewing department, we plan to buy new in these years. And for office equipment, we plan to buy new in these years. So our total for each year tells us how much we need to budget for capital expenditures. Again, this is buying new machinery and office equipment. So for all that information, we're going to drop it into a budgeted balance sheet. So on our budgeted balance sheet, we will have total assets equal liabilities plus owner's equity. It will look like a regular balance sheet, but it will be budgeted numbers. And we'll compare these budgeted amounts to actual once the actual occurs. And that completes this chapter, Chapter 21, Budgeting. Let me know if you have any questions.